From December 2007 to June 2009, the United States suffered an extended economic downturn that came to be known as the Great Recession. It was the worst financial crisis in the U.S. since the Great Depression, leaving an impact on homes and businesses in America and around the world. We'll look at the causes of the recession itself, and its lasting impact. While failures in financial regulation and excessive borrowing by households and Wall Street contributed, the primary cause of the Great Recession was the subprime mortgage crisis. A mortgage is a loan that allows people to buy a house up front. A subprime mortgage is normally issued to borrowers with low credit ratings. And historically, many banks wouldn't even make loans to people with bad credit. In the early 2000s, however, the housing market was booming, so banks began giving subprime mortgages to people even if they had low credit ratings. In other words, lenders, often banks, were loaning money to people who were less likely to be able to pay them back, and charging them more money for those mortgage loans through high interest rates. Now, on the face of it, it doesn't sound like the best deal for the lender or the borrower. But many people took on these subprime mortgages because they stood to make a large profit if their house increased in value. And that seemed like a pretty good bet. Houses had been increasing in value over the past several years. Home ownership had always been central to the American dream, and people who may never have imagined they could own a home saw the possibility in front of them. So, where did things go wrong? In 2007, the housing bubble burst. As demand went down, the prices of homes dropped rapidly. People stopped investing in real estate since it was no longer as profitable. Many people were no longer able to pay off their mortgages or sell their houses, and the banks foreclosed their homes. Since the foreclosed houses were now worth less money, financial institutions lost money too, along with the homeowners. As a result, the housing market failed, banks collapsed, the economy plummeted, and the Great Recession had officially begun. So, what did this mean for the average American? The economic downturn was devastating. Many people and businesses suffered huge financial losses and therefore spent less money, further damaging the economy. Financial firms were not as capable of lending money, and in 2008, the US government finally had to step in and bail out the banks, increasing the national deficit. During the Great Recession, more than 8 million Americans lost their jobs. Nearly 4 million homes were foreclosed each year, and 2.5 million businesses closed. Bank bailouts, federal aid to the auto industry, and government spending programs helped avoid an even bigger crisis. But it may take decades more to fully understand the significance of the Great Recession.